Welcome to the Insider Signal. We're here to talk about conviction, about capital, and really about the clearest signals you can find in the sometimes murky waters of the public markets. And we're not really interested in the legal or the, ethical gymnastics around insider activity. We're focused on the raw, actionable market intelligence. It lets us see where the most informed capital is moving.
Exactly. When the best in the business put serious skin in the game, that move is the news.
It is.
For professionals, you know this, the transaction ledger is often way more insightful than a quarterly report. We're in the business of tracking conviction.
And today we are researching in detail one of the most remarkable insider signals we've seen all year.
It's a total anomaly. It's a 9-figure trade that just completely, and I mean completely, contradicts the prevailing pattern.
We are, of course, talking about Alfred Lin. He's a director at DoorDash, and his absolutely immense $100.3 million discretionary purchase of DSH stock.
$100 million. Just let that sink in. Deployed right into the open market.
It's the financial equivalent of shouting your thesis from the rooftops, isn't it? It demands that we stop and analyze it in detail.
And here's the context that really elevates this from just a big trade to, something extraordinary.
Yeah.
Lin is making this colossal purchase. He's positioning Sequoia as the company's second largest institutional shareholder.
Right.
At the exact same time that every other insider, we're talking the CEO, the co-founders, has systematically sold nearly $700 million worth of shares.
Over the last year.
Over the preceding 12 months, yeah.
It's the ultimate contrarian bet. You have this institutional selling machine. It's chugging along, driven by diversification, tax stuff, whatever. It signals this cautious retreat.
And then Lin just steps in.
Steps right in with an aggressive, calculated war chest. This is not just an insider buy. It's a systematic rejection of the market's recent doubt.
So the mission for us, and for you, is pretty straightforward. We need to figure out what fundamental inflection point one of the most successful investors in history saw that warranted this kind of conviction, deployed right now. What did he see that everyone else was missing? Okay, so let's start by getting into the weeds of the transaction itself. The what?
Let's do it.
From the filings, we know the purchase was executed across 2 trading days, November 25th and 26th, 2025.
And that 2-day window is pretty common, right? For a high-volume trade like this, you want to minimize the price impact, but still the scale. It's just astonishing.
It is. The technical details show he acquired 401,439 shares of Class A common stock. You might also see a number like 514,047 shares.
Yeah, what's the difference there?
That just relates to the total ownership structure, including the Class B shares held by the Sequoia funds. But, the number that really cuts through all the noise is the capital.
$100.3 million.
Exactly. And he bought those shares at an average price of around $195. The trades ranged from, about $188 on the low end to just under $200.
So he was buying into a dip, but we'll get to that later. Let's talk about the ownership structure, because this is where things can get confusing.
Right, and it's so important. These shares were indirectly owned through several specific Sequoia entities. SC, UC Expansion Fund, Sequoia Capital Fund, and so on.
And why does that matter? Why should we care which fund it's in?
Because Alfred Lin exercises direct investment discretion over the capital in these funds.
Yeah.
This wasn't some passive allocation decided by a committee that's, far removed from the board.
Yeah.
This was a deliberate hands-on decision.
Yeah.
He chose to deploy capital right here, right now, because he saw the most value.
It's discretionary spending, pure and simple, executed by the guy with the ultimate visibility into the company. And then you compare that discretionary buy to the broader insider landscape, and the contrast is it's breathtaking.
It really is. Over the previous 12 months leading up to Lin's big buy, the collective sales from DoorDash insiders totaled roughly $698 million.
Almost $700 million. Nearly 7 times what he bought, liquidated by the people running the company day to day.
And the volume is, like you said, breathtaking. If you zoom in even closer to just the 6 months right before Lin's buy, the data is almost satirical.
How so?
The filings show 309 transactions reported by insiders in that 6-month window.
Okay.
298 of them were sales.
Wow. Okay. So almost all of them. What about the other 11?
The remaining 11 buy transactions, they all belong to Alfred Lin, all of them, bundled into this one block of activity in November.
So he didn't just break the pattern.
He was the pattern. He was the only pattern of conviction.
And the timing, it couldn't be more dramatic. We saw the CEO, Tony Zhu. He sold 288,410 shares, pulled in, what, $56.5 million?
Yep.
Just 5 days before Lin executed his $100 million purchase.
That's such a tight window. If you're a casual observer, you're looking at that and thinking, what is going on here? It looks like two insiders just sprinting in opposite directions.
And then you have the co-founders, Andy Fang and Stanley Tang. They were systematically liquidating over $124 million worth of shares throughout 2024.
Right, mostly under those planned trading arrangements. For a typical retail investor, seeing the core leadership selling that aggressively, that would be a huge red flag, a sign that the founders are, maybe ready to cash out and move on.
But the structure of the trades is the crucial differentiating factor here. This is so important when you're analyzing insider behavior.
Absolutely.
Lin's purchase was a deliberate, open market cash purchase at prevailing market prices. He took capital and actively chose to invest it right here.
Which is fundamentally different from the mechanical, passive transactions that dominate the sell side. The automatic exercising of stock options or the vesting and selling of RSUs for compensation.
One is just compensation management. The other is pure conviction.
And the outcome of this transaction, it significantly enhances his power base. Post-purchase, Lin's holdings through Sequoia amount to 32.3 million shares.
Which makes Sequoia, what?
The second largest institutional shareholder in DoorDash.
Right
behind Vanguard.
Wow.
That increased stake gives them immense gravitational pull. In terms of corporate governance, strategic direction, when you own that much of the company, your long-term thesis is basically a mandate.
Okay, so we've established the what's and the just mind-boggling scale of the capital. Now let's get to the who, because Alfred Lin isn't just some rich guy on a board.
Yeah.
He is, you could argue, the most important venture capitalist operating today. His conviction carries this monumental weight because his track record is it's impeccable.
Absolutely. When the #1 ranked investor on the globe makes a discretionary move like this, you have to assume there's a multi-billion-dollar reason behind it.
And he is a #1.
He holds the #1 position on the 2024 and 2025 Forbes Midas list. This isn't some flash-in-the-pan success. This represents sustained generational brilliance in identifying and scaling world-changing companies.
His whole career is just a masterclass in operational excellence and strategic exits. You think back to the late 90s. He co-founded LinkExchange with Tony Hsieh,
Right.
sold it to Microsoft for $265 million in 17 months.
17 months. That's insane.
It's insane. It shows this ability to see market gaps scale like crazy and then execute a hugely profitable exit with just breathtaking speed.
But for me, the most telling experience, especially as it relates to DoorDash, was his time at Zappos. He was the COO and CFO. He scaled that company from $300 million to over $1.6 billion in sales.
That's not just cutting checks. That's real operational grit.
Exactly. This wasn't just capital allocation. This is infrastructure, supply chain, organizational scaling. The kind of deep experience that gives him unique insight into DoorDash's incredibly complex logistics network.
And that all ended with the $1.2 billion acquisition by Amazon. He knows what a mature, dominant logistics company is supposed to look like from the inside out.
And his time at Sequoia, it's like a history lesson of the modern tech economy. He's been pivotal in Airbnb, Reddit, Uber, Instacart.
And, OpenAI.
And OpenAI, the titan.
Yeah.
If there's a theme in his portfolio, it's betting on companies that completely redefine huge sectors through network effects and operational superiority.
And crucially, his relationship with DoorDash isn't new. He's not a late-stage investor just hopping on board.
No, it's foundational. Lin joined the board way back in May of 2014. Sequoia led the $17.3 million series round.
So he has a decade of operational visibility. He's guided the company from, a startup concept in a garage to a multi-billion-dollar public company. That longevity gives him context, a forward-looking view that no analyst report could ever match.
You can even look back at his original 2014 investment thesis. It was published during the IPO process, and it really shows his predictive power.
What did he say back then?
At the time, he saw a $67 billion restaurant takeout market. He projected a future revenue opportunity for DoorDash between $8.6 and $11.4 billion.
Okay.
And he noted that only 15% of restaurants even offered delivery back then.
And this is where that decade of history really pays off.
It's perfect. That thesis was perfectly validated. DoorDash's 2024 revenue hit $10.7 billion.
Smack in the middle of his original projection.
Exactly. Lin already called the future of this company once and was spot on. And now he's placing another nine-figure bet on the next decade.
And you have to connect all this back to his career trajectory. In November 2025, just a few weeks before making this $100 million buy, Lin was elevated to managing partner of Sequoia Capital.
Right, a huge leadership transition.
A massive transition. So as he's stepping into this top stewardship role, deploying this kind of capital into a portfolio company, it signals more than just personal confidence. It's like a firm-wide anchor thesis.
That's a great way to put it.
He's demonstrating maximum conviction with his brand new platform.
Yeah. It suggests that while the broader market was running for the hills because of some margin fears, Lin looked at the Sequoia balance sheet and saw DoorDash as one of the safest, most growth-leveraged bets he could possibly make.
The conviction is clearly there. But the key question is still, why at $195? This purchase wasn't made during some celebratory stock run-up.
Not at all.
This was a tactical strike that exploited a severe market correction.
Precisely. The catalyst for his buy signal was a violent, 17 to 22% stock plunge right after the company's Q3 2025 earnings call on November 6th.
So the stock just fell off a cliff.
It plummeted from roughly $240 pre-earnings down to Lin's average buy price of $195. That's a huge 19% discount that he bought with surgical precision.
And what caused that panic? Why did investors suddenly get so spooked?
Well, management outlined a crucial strategic shift. They announced a plan to invest several $100 million into new initiatives during 2026, and the market, in its very short-sighted wisdom, immediately heard that as short-term margin compression and just sold off everything, terrified of a dip in reported profits.
Okay, so let's elaborate on that for a second. What are these new initiatives that got the market so scared, but got Alfred Lin so excited that he's willing to overlook some temporary margin compression?
Well, these investments aren't just, fuzzy R&D. They're directed at the long-term infrastructure you need for exponential growth beyond just restaurants.
Like what?
We're talking about automation and order fulfillment, aggressive expansion into last-mile logistics for non-food retail partners, scaling up the tech to integrate those huge grocery partnerships. Lin sees them building an impenetrable moat.
While the market just saw an expense line.
Exactly. He saw the market's fear as a gift. He was basically buying future dominance at a discount.
And if you look past that short-term fear, the underlying financial execution it's phenomenal. DoorDash hit this pivotal milestone in Q3 2025.
Their first quarter of GAAP profitability as a public company.
Which is huge. They posted $162 million in net income. That's a sharp reversal from the $73 million loss they had the year before.
And we should probably clarify what GAAP means here because it's a critical term. GAAP, or Generally Accepted Accounting Principles. That's the gold standard. It includes all the costs, stock compensation, amortization, everything.
It shows the true economic viability of the business.
Right. And that GAAP profitability wasn't just a one-time fluke.
No, it cemented a profitable year. For the full year 2025, they delivered their projected first annual profit of $123 million. And at the same time, they had robust adjusted EBITDA of $1.9 billion and free cash flow of $1.8 billion.
And again, that distinction between GAAP and adjusted EBITDA is crucial. Adjusted EBITDA strips out non-cash expenses like stock-based comp, so it gives you a clearer picture of the cash being generated from core operations.
So the fact that the adjusted EBITDA is so high, $1.9 billion, shows the business is a cash machine.
Exactly. And now that they've also hit GAAP profitability, it confirms the whole business model works, end-to-end, even with all the messy costs that tech firms often like to exclude.
And this is all being underpinned by just stunning core metrics. Their gross order value, or GOV, that's the total value of all orders on the platform, hit $80.1 billion. That's up 20% year over year.
Total orders reached $2.5 billion, an 18% increase. The network effect is clearly accelerating.
And their customer moat is getting wider. They grew to 42 million monthly active users, MAUs, up from 37 million the year before.
And that growth in MAUs feeds directly into their efficiency gains. We saw their net revenue margin expand by 60 basis points to 13.5%.
That margin expansion isn't an accident. It's driven by two things, right? Scale advantages, which let them optimize logistics, and their booming advertising revenue stream.
Right. Advertising is a super high-margin business that basically monetizes their huge existing customer base. It contributes materially to the overall margin profile and just shows how sticky the platform is.
Finally, the company is sitting on a fortress balance sheet, which is something Lin obviously respects.
Absolutely. They've got $4 billion in cash, versus $3.26 billion in debt.
And that liquidity, plus the new $5 billion share repurchase program, that strongly suggests that management and the board, including Lin, believe the stock is fundamentally undervalued. They're ready for any regulatory or competitive storm. To make a $100 million bet, you have to believe the company has this enduring competitive advantage, a real winner-take-most scenario.
You do.
And in the U.S. food delivery space, DoorDash is definitely the one holding all the cards.
Oh, it's undisputed. That market dominance gives them pricing power and superior unit economics. DoorDash controls a staggering 60 to 67% of the U.S. food delivery market by transaction value. The scale is just transformative.
And to put that number in context for everyone, DoorDash is currently 2.5 times larger than its nearest competitor, Uber Eats.
Yeah, Uber Eats is sitting around 23 to 26%.
And they are 10 times the size of Grubhub,
whose share has just completely collapsed down to the low single digits, around 6%. It's a wipeout.
And this dominance isn't just about volume, it's about the quality of the network.
That's right. DoorDash benefits from superior logistics density, and that translates directly into a better customer experience. Their average delivery time is reportedly 26 minutes.
Which is way faster than the 35 to 38 minutes you see from competitors.
Exactly. And that reliability drives tremendous customer stickiness. You see higher long-term customer retention, 47% for DoorDash versus closer to 29% for Uber Eats.
And that operational superiority is what's driving this massive industry consolidation. The shakeout is brutal, but it creates immense value for the survivors. We saw the tragic end of Grubhub.
Yeah, sold to Wonder Group for only $650 million.
That is a number that should make any investor just stop and think. It represents a horrifying 91% loss from the $7.3 billion that Just Eat Takeaway paid for it back in 2021. That level of capital destruction just confirms it. Only one or two platforms can really survive the delivery wars, and the winners to absorb the smaller players for pennies on the dollar, inheriting their customers without the competition.
But the question is, are they focusing too much on the U.S.? They've clearly signaled their global ambitions by acquiring Deliveroo for $3.9 billion. That gives them a critical footprint in over 40 countries.
It's a calculated risk, though. The European market is notoriously difficult.
It is. European delivery platforms collectively lost over $20 billion post-IPO. We saw so many large-scale exits. DoorDash is betting that their hyper-efficient operating model can succeed where others failed because they were undercapitalized and fragmented.
But if we want to justify Lin's $195 price point as a steal, we have to look beyond just restaurants.
We do.
The projected global food delivery market is just staggering. It's estimated to hit somewhere between $505 billion and $716 billion by 2030. That's a massive runway.
But the immediate, and I think most exciting opportunity is in grocery and convenience. The online grocery sales penetration in the U.S. is still incredibly low. It's floating between, 12 and 14%?
That's it?
That's it. And DoorDash is aggressively positioning itself to capture that market through partnerships with giants like Kroger and Albertsons.
So if Lin's 2014 thesis was validated by the shift of restaurant takeout from offline to online, his current thesis is probably about the transformation of grocery and convenience into a seamless, fast delivery digital experience.
I think that's exactly right. He's betting on the infrastructure, the drivers, the scale of the customer base, all of it acting as the default carrier for nearly every consumable item sold within a 5-mile radius.
That's a multi-trillion-dollar market opportunity he's addressing, not just billions, trillions.
Okay, let's transition to the core of this whole thing, interpreting the signal. We're always looking for leading indicators, and a discretionary insider purchase from someone like Lin carries a very specific statistical weight.
Yeah, we often rely on findings from academic studies, like that widely cited HBS study from 2022. That research noted that stocks with significant insider buying, and by significant we mean purchases large enough to be non-routine, they outperformed the market by an average of 6% annually.
Over 3-year periods.
Right. This isn't just a coincidence, it's intelligence translated into alpha.
And when you apply the established criteria for a strong insider signal, Lin's purchase isn't just strong, it's optimal. It checks every box.
Okay, lay them out for us.
First, post-decline. He bought after a severe 22% monthly drop. He maximized his discount and avoided buying into euphoria.
Check.
Second, scale. $100 million is so far beyond routine compensation that it's just a pure statement of value perception.
Sure.
Third, contrarian. He is actively buying into a narrative of fear while every other executive is executing these pre-planned sales. It's the perfect entry point.
And fourth, and this is the most important one.
Informed perspective. As a 2014 appointed director, he had the highest level of operational visibility. He knows the strategic roadmap for that 2026 spending. He knows it intimately.
Okay, so now we have to spend some real time on the big concern. The $698 million in insider selling. For anyone tracking this, that figure can be deeply unsettling. So why are we dismissing it as noise and focusing only on Lin's signal?
Because context is everything, especially in tech stock analysis. The overwhelming majority of those sales, the $698 million, are what we call structural selling. They're executed under 10b5-1 plans.
Okay, break that down. What's a 10b5-1 plan?
So a 10b5-1 plan is a trading arrangement that an insider adopts when they do not have any material non-public information. These plans set up automatic, pre-scheduled sales or purchases to be executed weeks or even months later, regardless of any news that comes out.
So it's all automated.
Right. And the goal is twofold. First, it lets insiders systematically diversify their highly concentrated wealth. And second, crucially, it creates a legal safe harbor against any future accusations that they traded using private knowledge.
In other words, these are mechanical, passive, legally necessary sales. They're often adopted months in advance to deal with expiring options or tax liabilities. They reflect a portfolio diversification strategy.
Not a real-time bearish view on the company's future. Lin's purchase, on the other hand, is the exact opposite. It's pure discretionary capital deployment made with real-time conviction.
And the market saw that distinction pretty quickly.
Immediately, following the public disclosure of Lin's purchase on November 29th, the stock jumped 4.3% in a single day.
That's investors following the smart money, validating the signal in real time.
And the analyst community quickly reinforced this bullish view. We saw Jefferies upgrades DAsh from hold to buy with a $260 target. Wedbush followed, upgrading from neutral to outperform.
And the consensus price target now sits where?
Comfortably between $273 and $284. That implies a significant, 40 to 45% upside from Lin's purchase price?
And it's rare to see that kind of unanimity. I think there are 0 sell ratings on DoorDash right now.
That's right. But we have to be the voice of skepticism here and talk about the valuation, which has always been the hurdle for this stock.
Okay, so let's address it. The trailing PE, based on past earnings, looks high. It's hovering between 97 and 115 times earnings. That would typically scream overvalued.
It would. But as we've established, this is the company at an inflection point. It's just hitting GAAP profitability and showing accelerating efficiency.
So the forward PE, the multiple based on next year's expected earnings, that's the more relevant metric. And that drops to a more palatable 36 to 59 times.
But the real metric for our audience analyzing a high-growth tech platform is the PEG ratio, price to earnings to growth.
This is where we get into the technicals. The PEG ratio takes that PE multiple and divides it by the expected annual earnings growth rate. The current PEG for DoorDash is an attractive 0.56.
And that specific number is so important. Generally, a PEG ratio under 1 is considered a strong sign that a stock is undervalued relative to its expected growth.
So for a company like DoorDash, a PE of 100 is fine if the growth rate justifies it.
Exactly. A 0.56 PEG ratio implies their expected growth will rapidly normalize that multiple, making the stock look inexpensive despite the high headline PE. Lin is betting his $100 million that 0.56 is signaling a massive dislocation in value.
That analysis certainly paints a very rosy picture. It justifies the $100 million outlay. But if we're really researching in detail, we have to look at the immediate headwinds. A purchase this big means Lin thinks the risks are priced in, but what could still derail this whole thesis?
High conviction is not zero risk. The most immediate and I'd say structural threat to DoorDash's unit economics comes from regulatory mandates, city and state level.
We're talking about the minimum wage mandates for delivery workers.
Exactly. They fundamentally changed the cost structure. We've seen New York City implement a minimum wage of almost $20 an hour for delivery workers.
And Seattle's even higher, right?
Seattle's at $26.40 an hour. These rules transform the traditional gig worker model into something much closer to full employment, and that significantly increases the cost of delivery.
And DoorDash has to offset that cost somehow. Their strategy has been to introduce these regulatory fees, like that $5 charge in New York City.
Right. And the risk there is the price elasticity of demand. If the total cost of an order The food, the service fee, the tip, and now a $5 regulatory fee. If that gets too high, it could really dampen consumer demand.
A 10% drop in order frequency because of price could just torpedo the growth metrics that Lin is banking on.
For sure. And speaking of risk, that elevated valuation means the market is demanding pristine execution. That forward PE, while reasonable for a growth stock, leaves almost no room for error.
And the 2026 investment spending, the very thing that created Lin's discount, will compress margins in the near term.
It will. And if his thesis about the strategic leverage of those investments is wrong, if they don't yield new, profitable revenue streams quickly, the market will punish that stock severely.
And what about the M&A strategy? We can't ignore the integration risk with Deliveroo.
No, you can't. That acquisition, while important for global scale, is a huge execution risk, integrating a massive platform in the challenging European market, a market that, as we said, has already seen multiple multi-billion-dollar flameouts. It's not a trivial task.
Then there's the sophisticated, ongoing competition from Uber. Uber Eats might not dominate food delivery, but Uber has a powerful, integrated rideshare and delivery ecosystem.
Their ability to bundle services, offer loyalty across transportation and logistics, leverage a single massive driver fleet. That's a sophisticated, long-term challenge that DoorDash, as a pure-play delivery company, has to constantly fight.
And finally, there's a reputational scrutiny. Back in November 2024, Culper Research issued a short report alleging issues with unauthorized contract workers. DoorDash denied it, but
the constant scrutiny on labor practices, transparency, profitability, it means the regulatory and public perception environment will always be a tight constraint on their ceiling. Lin is betting their operational excellence can withstand all of that.
But let me play devil's advocate for a second. You listed Lin's remarkable track record LinkExchange, Zappos, OpenAI, but even the best make mistakes. Didn't Sequoia have some exposure to the broader venture-backed flameouts? Does a strong track record eliminate all risk?
That's a necessary dose of skepticism. And no investor is infallible. Sequoia, like every major fund, has had its missteps. But the critical difference here is the nature of the investment. This isn't a new Series A round based on untested potential. This is Lin deploying over $100 million into a public company he has guided for a decade at the exact moment it hits GAAP profitability. He knows every operational metric, every regulatory exposure, every strategic move planned for 2026. This isn't a bet on potential. It's a bet on inevitable execution.
So he's taking advantage of the market's inability to see past the next 2 quarters of margin compression.
I think that's exactly what's happening.
So let's synthesize all the intelligence we've uncovered. What are the key takeaways from this extraordinary transaction?
I think what we've documented here is the highest conviction discretionary insider signal in DoorDash's entire history. The timing is surgical, executed perfectly after a temporary market pullback that he clearly viewed as irrational.
A pullback caused by short-term spending fears.
Right. All happening at the precise moment the company achieved financial maturity with GAAP profitability and was actively capitalizing on industry consolidation.
And when you look at the source, the consistent generational track record of Alfred Lin, from operational scaling at Zappos to picking market-defining investments like Airbnb and OpenAI, it makes the signal almost impossible to ignore.
It does. And we acknowledge that even elite investors aren't prophets. But the concentration of 9 figures in a company he's backed since its Series A suggests an unshakable belief in their ability to dominate the next phase of the logistics market.
This whole trade is like a textbook example. It shows the predictive power you can get from meticulously observing discretionary capital deployed by the most deeply informed sources.
It tells us that the nearly $700 million in mechanical 10b5-1 sales is just noise, and the $100 billion cash purchase is the true, unfiltered signal of anticipated alpha.
And that leaves us with the ultimate thought experiment for you, the astute investor, as we wrap this up. Lin's original 2014 thesis on restaurant delivery was validated perfectly by the $10.7 billion in 2024 revenue. So the question now is, what new multi-billion-dollar segment is he seeing that will prove his $195 purchase price to be an absolute steal a few years from now?
If DoorDash is already the undisputed king of restaurant delivery, is Lin anticipating that the $200 billion global online grocery market is about to be unlocked? Is he betting their infrastructure will dominate the entire instant commerce sector, moving far beyond food? The spending in 2026 will reveal the answer, but his nine-figure conviction suggests the opportunity is exponentially larger than the market currently perceives.
We'll keep tracking where the smart money moves, and more importantly, why it moves. Thanks for researching in detail with us today.